Hi everyone, welcome to the session. In this session, I'll be discussing about irrecoverable debt and doubtful debt. Okay, so let's look at what we mean by irrecoverable debt. This is irrecoverable irrecoverable debt and doubtful debt. What is the difference between? So basically, we should know the difference between irrecoverable debt and doubtful debt. Okay, so what is the difference? What is the difference? Okay, before we should know the difference, we should know the reason for this. What is the reason? So what is the reason? What is the how it arises? Okay, so the main reason is because of credit sales. Okay, if a business sells goods on credit, okay, on credit, there will be receivables receivables from customers. Okay, so when receivables are there, the business has to collect cash. Business should collect cash when there is receivables, because the cash is very important to run the operations. Okay, so sometimes customers may pay on time. Sometimes they pay on time. Sometimes customers may not pay on time. So there are several reasons why customer will not pay on time. So maybe a customer is bankrupt. If the customer is bankrupt, he is unable to pay, so he will not pay. Okay, and if the customer has died, so we will not be able to collect the money. And also sometimes customers might simply refuse to pay. So customers may refuse to pay. So in this case, if the amount is a small amount to be collected from the customers, okay, so it's not worth uh, putting a case against the customer, because your legal expenses will be more than the recoverable amount. Okay, so recoverable amount, so it is more than the recoverable amount. Your legal expenses will be more than the recoverable amount. So therefore, it is not worth of going to a legal consultant to recover this amount. Okay, so in such cases, okay, in such cases, you will never ever be able to collect the money. Okay, so such receivables are known as irrecoverable debt. Okay, so you will uh, you will never be able to collect money. So in such cases, okay, so what we had to do is we had to remove the receivable amount. receivable amount from the books. Okay, so this is irrecoverable debt, where you will not be able to collect the money from the customers due to uh, various reasons. Okay, and there is a doubtful debt where there is a contingency. Okay, you are not sure. Okay, you are not sure about receiving payment. Okay, and you are hoping the customer may pay in the future. Okay, so therefore there's a risk. There's a risk. Sometimes you might collect the money, or sometimes you might not collect the money. So in such cases, what we do is we have to make an allowance or provision. We have to make an allowance or provision to record this amount, this receivable amount. Okay, so such receivables will uh, will be treated as doubtful debts. Okay, so doubtful debts we don't remove from the books. We don't remove from the books. Instead, we make an allowance and we net it off with our receivable balance. So receivable will be will be under the financial position, will be under financial position under current assets. Okay, so that receivable with an allowance we have to net it off and we have to show the net amount under doubtful debts. Whereas irrecoverable debt, we are not going to collect from the customers. Okay, so therefore we have to write it off or we have to remove it from the receivable amount. So this is the main difference between irrecoverable debt and doubtful debts. Now let's look at a question how to deal with these type of questions. Okay, there's a question. Let's see. End of the financial year. End of the financial year. The receivable balance of SAM PLC is as follows. Receivable as at 31st December 2020, 58,300. This includes receivables from APLC 1,500 regarded as irrecoverable. Okay, which means we need to remove, we need to write it off, we need to write off this balance. So we will not be able to recover this amount. BPLC 1300 regarded as irrecoverable. The same, we have to write it off. Write off this. CPLC $2,500 regarded as doubtful. So therefore, since it is doubtful, we have to make an allowance or provision. Okay. In addition to that, SAM PLC decided to make a general allowances of 5% on the remaining receivables. Okay, and here also we have to make an allowance of general allowance of 5% on the receivable amount, whereas here this allowance is a specific allowance. This is a specific allowance because we know the customer, so therefore we have to make this amount as doubtful debts. However, in the general allowances on the overall receivable, okay, we don't know which customer will not pay. So therefore, on the overall on the total receivable amount, we have to make a general allowances, we have to make a general allowances 5% on the total receivables. Most of the companies, they arrive at these general allowances based on the past performance of the customers. Okay, so maybe looking at the past, on an average 5% of the customers end up not paying. Okay, so based on that, okay, you can have an idea, uh, how much to be provided as general allowances. Okay, so let's look at this, how this will be recorded in the books of accounts. Okay, as I told you, this receivable balance, okay, will be under current assets. So therefore, statement of financial position, if you take statement of financial position, you will have current current assets, right? Under current assets, you will have receivables. Okay, so receivable balance is 58,300. Okay, now from 58,300, what we need to do is the irrecoverable debt. Okay, so we need to write it off. Okay, so how much is that? We can write off, we can say irrecoverable irrecoverable debt. Okay, so we have 1,500 and 1,300. So once you deduct this amount, so that will be 55,500. Okay, 55,500. Then from this 55,500, we have a specific allowance of 2,500. So you can say this is allowance for doubtful debt. This is allowance for doubtful debt, 2,500. So after this, the balance will be 55,500 minus 2,500 will be 53,000. Okay, so this is after the specific allowances of CPLC. So in addition to that, SAM PLC decided to make a general allowance of 5% on the remaining receivables. So the remaining receivable is 53,000. Okay, so therefore, now I will take it here. So we have 53,000 receivable balance now. Okay, receivables 53,000. On this, we need to deduct 5% general allowance for doubtful debt. Okay, so how much that will be? 5% on that will be 2,650. 2,650. Okay, so the remaining, the net receivable will be 50,350. Okay, so this is how your receivable balance will show in the uh, in the financial position under current assets. So net receivables will be 50,350. But in the presentation purpose, in the financial position, so what you need to show is the uh, net of irrecoverable debt, which is 55,500, and the allowances for doubtful debts. Okay, so I will show you how to present this. Okay, so let's say statement of financial position. You have current assets, you have current assets, then we should take the receivables net of the write off, which is how much? We have how much? Net of these two irrecoverable debt, 55,500. Okay, so we should take 55,500 as receivables on the face of the financial position. Then we should deduct allowance for doubtful debts. So this is how you have to show on the face of the financial position. So doubtful debts, we have two components, specific provision and 5% general allowances. Okay. So specific provision, we had how much? Uh, Specific we had 2,500, and general we had 2,650. Okay, so simply we need to add 2,500 and 2,650. 2,500 plus 2,650. So thereby the total will be 2,650 plus 2,500, 5,000, 5,150 we need to deduct. So that will be 55,500, 50,350 will be shown in the statement of financial position as net receivables. Okay, then afterwards show the necessary entries in the financial position and in the income statement. In the income statement, what we have to show is, now we had an opening balance of 58,300. However, after all these irrecoverable debt and allowances for doubtful debts, our net receivable should be 50,350, uh, which means we have to certain amount we have written off, certain amount we made an allowance for doubtful debts. Okay, so these irrecoverable debts and allowances for doubtful debts has to be shown on the face of the financial income statement as an expense. Okay, so we need to show these as an expense because our receivable balance from opening balance 58,300, it reduced to 50,350. Okay, so therefore this reduction is treated as an expense, therefore it has to be shown on the statement of uh, profit and loss account or income statement. It has to be shown as an expenses along with other expenses, as you can say allowance for doubtful debts, and you can show the combined one or irrecoverable debt. The total you can show on the face of the income statement. So how much that will be? We had 2,800 irrecoverable debts, 1500 plus 1300, which is 2800, plus 2800 irrecoverable debt, plus 5150 as allowances for doubtful debts. Okay, so the total will be how much? 2800 plus 5150, 7950. 7950 has to be shown as an expense in the income statement, because our receivable balance reduced by 7,950. So this has to be shown on the face of the income statement. Okay, so 7,950, 58,300 minus 7,950 will be 50,350. Okay, so this is how you have to deal with irrecoverable debts and allowances for doubtful debts. Okay, so I'll see you soon with another video discussing about some questions relating to irrecoverable debts and doubtful debts. So thanks for watching. I'll see you soon again.